How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training course. And what we're going to go in today is Market Mondays for 3/29/2021. And to really reiterate, if it's your first time watching this video, first time being on this particular broadcast, hit us with a like, hit us with a sub. Tell somebody about it so they can also come through with a like or a sub. We can spread this particular platform and spread this broadcast out to more people. And the reason why we do Market Mondays is we want to give you a market-based conversation that's going to help you raise your level of intelligence about the markets, show you how the markets can be beneficial to your life, and try to kind of erode or eliminate the belief that to understand the markets, you got to go to school for 10 years, you got to have a PhD, you got to have a background in finance or economics, and you got to be one of those people on CNBC with a suit on. We want to kind of show you how the markets can be beneficial to your life and how you can start learning how to create income for yourself and make money using your brain, as opposed to thinking that you have to use your body and that you have to do a lot of long hours to be able to get money out of the markets. So what we're going to do is go into Market Mondays for 3/29/2021. So we're going to go over some basic market information. So the Dow started red, it closed green at 0.30%. NASDAQ closed red at negative 6.60%. And the S&P 500 closed red at negative 0.09%. And one of the reasons that we believe the market started off red is because of a lot of uncertainty in the market. And one thing that we know about the market is it does not like uncertainty. So if the market is uncertain about how a situation is going to go, a lot of times you'll see the market go red for that day until that period of uncertainty is over. A lot of times the market doesn't have issue with bad news. What it struggles with is uncertainty, because people don't know what direction to go in. So as a result, they get scared, and a lot of times they start selling. So there was the issues with a hedge fund that kind of started last week, and it kind of hit the forefront on Friday. And a lot of people uncertain about how issues with that hedge fund would affect certain U.S. banks. So as a result, we had a lot of selling on Friday. We had information last night that certain banks were looking to do block trades of stocks starting in the AM. So as a result, there was a lot of uncertainty. Now, one thing that we did get was that ship that was stuck in the Suez Canal was refloated, which means that they were able to get it free from it being stuck. You know, nobody really understands how it got stuck, but they were able to get it free. So we think eventually what we're going to have is the Suez Canal is going to be reopened for business. So now let's get into the jump outs. And what we're going to talk about is companies that did really well this week and also companies that did not do really well. And we'll give you some context to it. And one thing I want to talk about before we go into it is that study how the Treasury yield really was not a factor for the market being red. And so what we're talking about before is that we think that people are getting desensitized to the Treasury yield to where eventually it's going to be a non-factor. Let's get into the jump out. So this is something that I talked about on the Classic Climb show with Erica Williams. She did a special stock segment show this weekend, and we talked about GSX. And, we kind of gave you some context to where this is an online education company in China. There's a lot of allegations that they are involved in some type of fraudulent accounting, and they've been selling off. And I'm showing you their 5-day chart. If you look at their 5-day chart, they've come down from around $83 and they're closing today at around $31.78. That's a massive drop. They've been selling off longer than that. They've essentially sold off from around 100. I've been watching this company for a long time. There's a video on this particular channel. I think I did maybe in either November or December. If you would have watched that video and understood what I was talking about, you could have put yourself in a position to make a lot of money. Not a guarantee, but you could have put yourself in a position to make a lot of money if you would have understood what I was trying to express in that particular video, done a little bit of research and kind of understand how to trade options. However, with this company, we see it losing 20% or almost 20% again, even today. Okay, so when a company's losing that kind of value, day after day after day after day, there's something going on. Okay, some companies don't lose 20% all year. When a company's losing that kind of value, and this is a big issue, there's something going on there, and it demands a lot further investigation. And so this is a company I've been watching a long time. I don't necessarily have puts on it now because a lot of the trading activity, I could not stay in the position long term because I just didn't have the capital. This is one of those kind of plays where if you have the capital, you get puts out as far as possible, maybe even a year out, and you just sit back and wait for everything to unfold because you have a conviction that eventually this whole situation is going to get shut down. What I personally think they're going to do with this is they're going to continue to just sell it off in anticipation of maybe like a delisting event. And what I mean by delisting is that when it gets probably taken off the New York Stock Exchange, it's no longer allowed to be traded. So what they may be doing is just playing it down, selling it off little by little. So then when it gets delisted, it's not as much as a drop off as maybe something like a Luckin Coffin. So still at 31.78, there's a lot of meat left on the bone, but you may want to start looking for a bounce back, a dead cat bounce, where it eventually may sell off again, or they may run this thing back up to $100 again so they can sell it back off again, because they ran it up to, it went down around 50, 45. They ran it back up to 110, and then they just walked it right back down. So a lot of the trading activity on this particular ticker is very, very unusual, but this, from a put standpoint, can be very profitable if you understand how to play put options. And I don't mean that you're selling, if you're selling put options to people on this stock, to me, you're delusional, because you're either going to get exercised, right? Or to buy 100 shares of this ticker just to sell one contract. It's the money that you're going to make in put contracts, to me, will not be worth it, right? Based on the premiums that it's going to pay out. However, everybody got different ways to trade, so I don't knock anybody's hustle. Get money how you get money. Now let's go into Nike. So what we saw, Nike did a nice little bounce up today. Opened, it kind of sold off early at the open. Then it started to move up forward. So they're kind of recovering from that issue that they had with the Chinese government. And I telling somebody earlier today, I think Nike behind the scenes is going to fix that issue. Nike's been doing business inside China going on over 20 years. They send a lot of their athletes over there to do expositions and to do, little demos. And so Nike doesn't really have a desire to get on the wrong side of the Chinese government, because they got really, really deep and long-standing relationships over there. So, Nike sold off a little bit because of their issue with China. Also, some questions about whether or not COVID was going to impact their revenue, but they should be moving back up. I think they were around 140, maybe less than 30 days ago, maybe less than 60 days ago. And so we want to try to observe and see if they're going to move back in that direction. Now let's look at crude oil. It's something that we were talking about. So if you look at a 1 year of crude oil probably over the past 40 days has probably gone up $10. The 1 year was kind of flat for a very long time. And then now we're starting to see it move up a little bit more. I think personally, crude oil is going to ready to move up, because they're going to kind of probably push it up and support it for the summer. And then also with inflation, we got to understand how we think OPEC is going to act in regards to their supply, and whether or not they want to maybe move crude oil up as a reaction to inflation. Therefore, me personally, and this is not investment advice, I think crude oil is going to continue to move up as the year goes on. I think reopening because of people getting vaccinated because of COVID. I just got information on my city website that they are now promoting people 40 and under to get vaccinated. So first it was the elderly. Now they're promoting for people 40 and under to get vaccinated. 40 and older to get vaccinated. And they said like in a few weeks, they're going to start promoting for people 18 and older to get vaccinated. So as we roll out more and more vaccinations, people start traveling a lot more. We're probably going to see crude oil go up, because there's going to be a lot more demand. And then if OPEC starts to throttle supply, then that's going to spike the price up. So I would tell people to kind of really observe crude oil long term and kind of see where do we think it's going to go as we start approaching the summer. Now let's talk about the topic of the day, right? And so we want to talk about what happens when you buy the dip and it dips lower. And so did a video, I want to say maybe 2 weeks ago, where we talked about, a lot of people have bought into the platitude or this colloquialism that a lot of people get from these guys on YouTube and these quote unquote gurus and market experts that, you should just buy the dip. So, if you buy at $100 and it dips to 70, well, then you should just buy the dip, because you're getting it at a discount. Told you before that if you go to the retail store and something is priced for $10, let's say that's a hypothetical price, and then, you come back next week and it's priced for $5, well, there's a reason for that. The reason is not that it's on sale and that the vendor or the actual retailer is trying to do you a favor. Most likely it's priced that way because there's no demand for it. Therefore, you got to kind of understand, once you understand market principles and market economics, and you really understand a basic supply and demand graph, when a company starts selling off, there's a reason for that. And it doesn't mean or doesn't justify that you should buy it at a lower price. Because the question is, why is it at a lower price? So if the price point was ever at a certain point, the question is, why is it going lower? So now looking at Tesla, right? Because a lot of people promote buy the dip under any circumstances. You should just buy the dip. which is really compulsive behavior. You're looking at Tesla at one time was 900, sold off from 900 and probably hit around 870, maybe 865, maybe 880. And then from that particular point, it's sold off again. If you're looking at the purple, really, I call it a slope, but it's really a line. That's a moving average. So the purple moving average is a 23-day. So that's the average price over 23 days. And then the coral blue moving average, which is a thinner line, that is the 50-day moving average. Now, one thing that a lot of people don't understand moving averages is that the farther the actual candles, or really the price point, right, combined with the volume, gets away from the moving average line, the more bullish or bearish that trend is. So when you're looking at Tesla, looking at the purple, which is the 23-day moving average, you see that big red bar right where it almost touches, right? Then it goes, you got almost a death cross there to the right of that. You got a green, you got a red, you got two greens, you got a red, and you got that massive red bar. When you get around that third red bar, right, you get the big red bar, almost like a death cross. Then you have the green bar. Then you have that red bar that's to the right of the massive red bar. So let me use do I have a cursor? My cursor is not working. So right up under that purple line, you got that big red bar that's slightly above 800. To the right of that, you got almost a death cross, right, which is a small red bar. You got a green bar, then you got a red bar. That third red bar that's to the right of that green bar is a massive amount off of that 23-day moving average. Then it goes green, and red again. That other red bar that's to the right of those two green bars is even farther off that 23-day moving average. Then you have the massive red bar, which is right under, right, the coral blue 50-day moving average. So you got to understand, the farther we get away from the 23-day moving average, the more bearish, right, indicators that we're getting. So if you're a person that really believes in moving averages, you got to understand that Tesla currently, from a short-term span, is very bearish. Then we look at the 50-day moving average. It's also very bearish, because if we look at the red candle, right, that is right under 600, that red candle that's right under 600, what it says 611.29. Look how far we are away from the 50-day moving average and the 23-day moving average, where they intersect. So we see the intersection of the 50-day, 23-day moving average. We see the 23-day moving average moving under the 50. We see that intersection point, and then look how far that red bar is way under that. Okay, so if you're continuing to buy the dip, what you're doing is you're waiting for a reversal. Okay, so let me explain something to you about how most companies trade. And like I said before, is that this is the kind of stuff you can't go to college and learn how to read a chart. Okay, so a lot of this information that we're giving you really low key is cutting edge, because there's not a school in the country, as far as an academic institution, that can teach you how to read charts. Most companies, when they trade with I would call like a healthy trading pattern, and healthy to me is subjective, you're going to see consolidation, either build up, consolidation, either sell off, right? You want to kind of look for that kind of behavior to know that it's not like a lot of really euphoric or frantic trading behavior, because that's normally not going to be sustainable, because there's a lot of enthusiasm in this particular company that's not sustainable. So it's hard to sustain over the top enthusiasm in any scenario. So when a lot of people are running into a company because they have over the top enthusiasm about the company, it's hard to sustain that emotion. So Musk cannot sustain the over the top emotion around Tesla, because it's impossible, right? It's impossible to continue to feed that fire. So when it runs up because of that, eventually it has to come back down. As while it's coming back down, if you've been programmed to buy the dip, the problem is you're buying a dip that's based on a letdown in enthusiasm. You still don't really know the real price of this company. Why? Because it was all based on enthusiasm and a lot of hype. You're looking at candles that are 1 year. It's a 1 year chart based on daily candles. So every red close was a point in which it closed lower than it opened. Every green candle is a point in which it closed higher than it opened. If we start looking at the red closes around the $800 price point, where you got that big red bar, well, essentially it went lower almost every day. So we're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost 20 days in which it just kept selling off. But people were still believing buy the dip, and it just keeps selling off more and more. And then it's underneath the moving averages. Now it's not underneath the 200. I don't know whether or not it's underneath the like maybe a 70-day moving average, or maybe a 75 or 72-day moving average. But it's definitely under the 23 and the 50. It is still over the 200, but the 200 moving average pretty much goes all the way into last year. So you want to understand is that when you buy the dip and it keeps dipping, you want to kind of ask yourself, is it better sometimes when you see a company selling off like this to maybe sit on the sideline and kind of see where it consolidates? Now, if you're a Tesla bull and you totally are a believer in the company, you're a believer in the mission of Elon Musk and what they're trying to do, then I'm all for it, right? But to me, Tesla was overvalued. It had a market cap of almost $1 trillion. I didn't see anything to substantiate that market cap. I understand that they're going to have a lot of, I don't really think they're ever going to be a dominant car company. I do think they're going to be able to leverage a lot of their data that they're collecting, but I don't think their data collection is going to justify $1 trillion market cap, right? Or $700 million market cap. So I think they will be able to furnish a lot of other car companies with very, very important data because of a lot of the data mapping that they're doing. But I don't think it's going to justify a 700, 800, 900 billion dollar or maybe even $1 trillion market cap. So what we're seeing is that it's constantly selling off. Now, what you see is that when it reaches a particular point around that 23-day moving average, it bounces back up. It touches that 23-day moving average. And what does it start to do? It starts to just kind of slide down off that moving average to where we have where we're at right now today at 611. So we're seeing that it's sold really hard off the 23-day moving average. It bounced back up. It consolidated a little bit, and then it started to sell down back again off that 23-day moving average. So what we have not seen is once we started this really, really hard selling off that $900 price point, or really maybe that $880, we didn't get any consolidation. And what I mean by consolidation is where we're selling it's trading in a very, very tight range, and it's building up to either go up or go down. Once it hit that particular number, it just really started to sell off. And we can have every reason in the world why it's selling off, but it's selling off. So even though Kathy Wood has a price target of 3,000 with no real date on that price target, which is easy. I can say, well, you know what? I think Amazon one day will be 10,000. Well, if I don't put a date on it, yeah, eventually it'll be 10,000. It may be 10,000 in 30 years, right? So when you're coming out with a price target, does that mean within the next 6 months to a year, you believe Tesla's going to be $3,000? Even with her giving out very, very bullish price targets, it's still continuing to sell off because of a lot of factors going on in the world where nobody really cares about that. They've essentially taken their profits and they're getting out. So what I'm looking for Tesla to do, and I talked about this before, is probably consolidate maybe around the $400 mark and then trade sideways unless something comes out that is going to allow people to reestablish their enthusiasm. As of right now, what's going on in the market is hurting enthusiasm around Tesla because of all these other factors. And I just think, like I said before, is that it's hard to maintain that emotional exuberance. So when you're buying the dip and it dips lower, you need to ask yourself, what loss are you willing to take as it continues to dip? So if you were to buy into this particular company, let's say at 750, right? And right now it's closing at 611. Right? 608 in the aftermarket. How much are you willing to lose off your initial buy-in before you realize that you made a mistake? Now, like I said before, you're going to be a 40 or 50 year Tesla holder, well, then just keep holding on, because it doesn't matter what losses you take on your initial position. You're going to hold it anyway. But when you're looking at a company that really, truly was overvalued from a price point standpoint, you bought in because it was overvalued, because you believe it was going to continue to keep running up. Now that it's selling off, do you say, well, you know what? Let me take my loss and get out and wait for some level of consolidation so I can reposition? Or do you just sit in it and just deal with your loss? Or do you continue buying the dip, right? Because your attitude is, well, you have to tell yourself I'm getting it at a discount. So yes, if you buy Tesla for 608 and you initially bought in for 750, you did get it in a discount, right? But you may find out that it continues to keep getting discounted. Okay, so what I want to really encourage you to do is to get rid of a lot of the platitudes and a lot of the colloquialisms that you hear in this particular space. They're created for a reason. They're created because A lot of people think you're simple. And one of the things that they're taught is that if you want to deal with people that you really believe are simple, you don't really give them a thorough explanation. You give them a colloquialism, or you give them a platitude for them to believe in that's easily repeatable, that you can program them with, without really giving them true understanding of what's going on around them. So there's a lot of that going on, because a lot of people, in the way in which they're educated, they educate people in that same way. Therefore, there's a lot of people running around thinking I need to just buy the dip under any circumstances. And like I said before, is that if you go to a grocery store and an item is $10 and you come back a week later and the item is $5, there is a reason for that from an economic standpoint. There was an economic reason why they've taken $5 off the price. And without you knowing that reason, it doesn't justify you buying it, unless, like I said, is that you have such an emotional desire to purchase it. You disregard the fact that it was $10 this week, it was $10 last week, and this week is $5. Well, there's something going on there, and you may want to investigate the reason for it. So there's a reason why Tesla, has went to 900 and it has just been selling off ever since. There's a reason for that. As opposed to buying it because you think it's discounted now, what's the reason? And I would encourage people to figure that reason out, or to come up with a reason that makes sense to you, before just running into a market and buying something because you think now it's discounted because you believe in buy the dip. So that's going to be Market Mondays for, 3/29/2021. If you have any questions, hit me up in the comments. If you want more information about the highest paid part-time job in the world options training course, the IPO course, we killing it with that IPO course. That's eventually probably going to be a high ticket course, mastermind probably built around that. Reach out to me. If you have any questions, hit me up in the comments. If you don't really understand what we're talking about, hit me up in the comments. I may be able to help you get some clarity. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.